More information about the Secure Act. I'm Bill Davis. Join us for that and more next on Your Wealth Health. Welcome to Your Wealth Health here on FOX Michiana. We're practicing social distancing. I have Matt Aurenz here, private wealth advisor with the firm. If you're watching us on yourwealthhealth.com or Facebook, please share us, please like us. There are other people that could possibly benefit from the topic that we're talking today, and that is the Secure Act. We're going to jump right into it and review some of the aspects of what's going on in the economy. All 50 states have now reopened for business at some level or another. Here in Michiana, we've received some great news from our largest employer, the University of Notre Dame. You know, we rely so heavily on football Saturdays and restaurants and hotels and the travel industry here in Michiana. The school's announced plans for students to return to campus for the fall semester, and that sets the stage for some possible football. There's a sense of optimism across the country, even though we have a long way to go, and Fed Chairman Powell says he doesn't think we'll have a full recovery until we have a vaccine. But the market's been doing pretty well. The question is, will it continue, and what are the key signs of the economic recovery? Matt, what are some thoughts that you have in this area?
I appreciate that, Bill. I think first and foremost, it is exciting to hear that Notre Dame's going to resume fall semester classes in person. That's exciting. Football season is one of those things I think this town and this community really can rally around, and that just builds some nice synergy. But I think when it comes to economic activity, what we're beginning to experience is really a snowball effect. We get a little bit open here. People test the waters, people go out a little bit more, then they're going to start going to some restaurants, they're going to start hitting the movie theaters and the malls and the shopping, and those types of activities really build confidence in people to say, hey, all right, we're taking precautionary measures as best as we can, but we can't be closed down forever, and I think people are ready to get outside. The weather's getting nice. It's time to have some fun. So that's good economic-wise, economic activity-wise, market conditions. There's going to be a lot of hiccups, a lot of headwinds still. We're not expecting earnings season for a second quarter to be good. I think everybody's really come to grips with that. I think that the stocks are probably a little bit overvalued, but people's optimism is pushing that up. So, you know, if the economy gets going again and earnings start coming back, those will eventually work themselves out, but we don't feel like you've missed the boat. Don't feel like you've missed the bottom. There's still opportunity to pick some good investments. So just work with your advisor, work with your professional to say, hey, am I on course? Am I on track? But starting to get some good optimism, Bill. I'm encouraged by it.
Thanks for that, Matt. You know, we've kind of changed the format slightly, in that last week we started to talk about the changes of the Secure Act, the strategies. This week we're going to talk a little bit about the tax implications, and pick up then the next week with kind of a case study. So what we want to do is we want people to have a reality check as to what are some of the strategies that they might be able to use for their own situation. So we have a graphic of changes to distributions, and Matt, could you take a moment and talk about that graphic?
Sure. The main things on this are, you know, the Secure Act, which is setting every community up for retirement enhancement, really focuses on a few things. The primary focus is going to be, and changes, is the required minimum distribution age, which we've touched on a little bit before, but that's moving from 70.5 to 72. So it just prolongs people having to take money out of their IRAs if they don't feel like they want to. There's no more stretch IRAs, which is a big one for a non-spousal beneficiary. So those assets have to be depleted within 10 years from the date of death now. for anybody who's a non-spouse beneficiary. And then qualified charitable distributions from your IRA are still allowed. Those actually can still be done at age 70 and a half, and you can do up to $100,000 a year. So it's actually, for many people, way more than what the required minimum amount is. It gives them flexibility, control, that distribution, that gifting to charitable contributions and organizations. So there's some pros and cons, there's some give and take, but it's the reality of the new law, and we can start planning with it.
Yeah, thanks, Matt. We believe that this is the biggest change in the tax law in the last decade, and it's going to provide some significant opportunities for you to do some planning, to begin to bring in the next generation, to help them understand what they will face as you approach this topic and the estate planning changes that you might want to consider. So Matt, do you have any ideas on how people might be able to take advantage of some of these planning opportunities?
Yeah, Bill, that's a good thing. You know, what I find is most people, they want to get this stuff done. They want to look at their tax implications. They want to look at their estate planning. Sometimes it's just they don't know where to start, or it's really not a friendly topic to talk about, right? Nobody likes talking about, I want to pay a bunch of taxes and I want to, kill myself off to figure out what's going to happen at the end of my estate and how it functions and where it goes. This is not a friendly, fun conversation, but it's one that people need to have. And so you got to just start somewhere. And usually that's the biggest hiccup, is people say, I don't know where to go. I don't know what to do. And we would just encourage you, if you're in that situation, reach out to us. We'd be happy to talk with you for just a few minutes and get you on the right path. And begin with, okay, what is it that you want to have done? Start developing that goal of if I'm no longer here, what does that look like? How do I want to take care of my family? How do I want to protect my family? Are there organizations I want to contribute to? What does that transition look like? And that's really, I think, the easiest thing, is to start determining, what do I want done? And then we can help you from there.
Great, Matt. We're gonna jump into some of those strategies when we return. Realize that we do offer a complimentary 30-minute phone call. If you have questions for us, you can certainly schedule that at yourwealthhealth.com or hilltopwealthsolutions.com. When we come back, we're going to jump into some strategies and look forward to it.
Well, Rick's Auto Body means to me, so I just believe that we all have God-given talents and we have a God-given purpose in life. And I believe mine is problem solving. So I use collision repair as just a way to fulfill my purpose in life. So Rick's Auto Body to me is something that my dad gave me as a good start, and I took it and we're building from there. But the purpose of it is to help people and to solve their problems and to be a servant in the community. Our family has been in collision repair for 47 years, and now we've expanded to 2 locations, one in Mishawaka, one in South Bend, both with the same core values of repairing vehicles and putting people first. And this facility here in Mishawaka gives us that extra room that we can really get the higher trucks in, and we can do collision repair to the higher trucks. So if you want to have more information, you can call or text my cell phone, 574-532-0658, or you can go to ricksautobodysshop.com.
Welcome back to Your Wealth Health. I'm Bill Davis, and I'm filling in for Eric, who is on vacation this week. I'm joined here in the studio, 6 feet away, practicing our social distancing, Matt Aurenz, private wealth advisor with the firm. Appreciate you being with us today, Matt. We're going to now jump into some tax strategies, but before we actually get into the strategies, we're going to get into the way buckets of money are taxed. And so don't think about any individual investments. We're not talking about what kinds of investments are in these buckets. We want you to grasp how different buckets of money are taxed. So Matt, let's jump into the tax control triangle and start wherever you'd like.
Sure. Bill, we've been using this for a good 20 years now, and it's one of those graphics that really just helps you understand how buckets, umbrellas, whatever you want to call it, work when it comes to various products, investment solutions, account types and structures, and which one they belong in. Because I think a lot of people have various investments and they grasp how it works, but they're not really thinking of the big picture. And what we find here is you really have three main buckets. Bottom right-hand corner, you're going to see there is really your pre-tax bucket. Money goes in pre-tax. You don't pay any tax on the contributions. When it comes out, it's 100% taxable. Top bucket, that's your tax-free bucket. So you're putting in money post-tax. It's already been taxed, contributions, grows in the account, traditionally tax-deferred. When it comes out, it's tax-free. You're not paying any tax on those gains. And then the left bucket there, that's the after-tax bucket. And that after-tax bucket is basically put money in after tax. You're paying taxes along the way on any type of distribution. So you really have three different tax structures, Bill. And for years we've figured, okay, how do you maximize your tax strategy? It's appropriately putting money into each bucket, wouldn't you say, Bill?
Yeah, that's the tax control, is why we call it the tax control triangle. Now, what our experience shows us is that because of 401ks that came in the late 1990s, most people's tax deferred bucket, the bottom right corner, is the largest bucket. And if they had pensions, that's 100% taxable. The withdrawals from this bucket are 100% taxable. And because this accumulation has been going on so long in these employer-sponsored plans, we find that there's an overbalance within the tax-deferred area. And this could have an effect while you're in retirement, as you're getting closer to that retirement goal. But because of the Secure Act, now with the 10-year distribution rule, it will force your beneficiaries to withdraw that money within a 10-year time period, which we think will offer some opportunity for planning for those beneficiaries. But we also want to help you control the amount that's in that bucket prior to retirement.
Right, I think it's a good point, Bill, because it's the distribution and the tax implications are today, during retirement, and upon your death. And you really need to have the balance in all three to control all three scenarios of your life. And what we find, like you said, is most people, particularly with employer-sponsored plans these days, are filling up that pre-tax bucket. And rightfully so, right? It's coming out of your paycheck, you're deferring it right away, you're reducing your tax burden today. Oftentimes you're getting an employer match. It's just an easy place to put money. It's a turn on the switch and money goes in, it's invested, you don't think about it, and 20, 30, 40 years later, there's a giant pool of money there to support your retirement income. The unfortunate part is, what we find, usually, Bill, is now you're in retirement and you're stuck in this distribution phase and you're paying an exorbitant amount of taxes that you didn't think that you were going to have to pay, which, I don't know what your thoughts are, Bill, but mine are taxes are probably going to go up in the future.
If I were a betting person, I would certainly believe that the taxes are going to go up just because of the debt crisis that the government's in. So let's talk, Matt, a little bit about funding of things like Roth IRAs. I think that there's a challenge because the limits are so much higher on the defined contribution plans of these 401ks. But people are limited on the amount that they can put in a Roth IRA. So now we have to start thinking about things like maybe Roth conversions.
Right, Roth conversions is a great opportunity. So your Roth IRA, if you're below the age of 50, is a $6,000 max contribution. per spouse. And if you're over the age of 60, or excuse me, over the age of 50, you can do $1,000 catch-up. And while that's good, that does have income earnings restrictions on can you or can you not put in contributions. And in good news, you do have employers who are starting to add the Roth feature as a contribution option in employer plans, but not all of them do. It's a slow start there. So Roth conversions, right, Bill, is a huge opportunity that we're seeing for people to try to move money from that pre-tax bucket up into the tax-free bucket. And that's primarily, again, going back to your point of, do you think taxes today are going to be lower than they are in the future? And tax brackets most likely will be higher. We don't know, but if we were making that betting gamble, we would say, yeah, likely they will be. And so if you believe you're going to be in that situation, it would behoove you to pay some tax today and convert to an IRA, to convert to that Roth IRA, pay the tax today at potentially a lower tax bracket, allow that money to grow tax deferred, and take the distribution at a future time when tax brackets are likely higher at a tax-free withdrawal rate. So you're not paying income tax.
Yeah, and one of the things that we haven't used for a while might be some permanent life insurance. We might have some extra income that we want to defer into permanent life insurance. It could be tax-free, possibly to the owner and to the beneficiaries, since life insurance proceeds are tax-free. But we also might convert some qualified money. So some of the money that's been, say, accumulated in traditional IRAs, 401ks, possibly paying a little bit of tax today. And we're going to show you when we get to our tax strategies how you can determine to take out money at your current tax bracket without putting yourself into a higher tax bracket. So what about potentially converting some money after 59 and a half over to maybe some traditional life insurance? You think that also could be an opportunity, Matt?
I think it is. I think it's definitely going to come down to a very specific scenario. So it's not something that's for everybody. I think we want to make sure that's clear. But I do believe that there are circumstances where it can benefit somebody. It can benefit their estate. It could benefit their tax planning strategies. I know a lot of people gifting to churches or charities or various organizations. They're looking to maximize and leverage the money that they have today to gift upon their death. And life insurance is definitely one of those strategies to do that. And number two is it's definitely a strategy to replace the wealth that you're going to lose due to taxes at your death. And so the replacement strategy is another great opportunity, I think, Bill, for many people, again, when the situation makes sense.
Yeah, we haven't focused too much on the non-qualified bottom left corner of the tax control triangle. But when we come back, we're going to talk about some estate planning strategies with that, possibly low basis stocks, charitable gifting could be a strategy. But when we come back, we're going to jump into some more estate planning strategies right here on Your Wealth Health. Don't go away.
Sam's Car Wash, corner of State Road 23 and Fur Road in Granger.
We the people of the United States, in order to form a more perfect union, establish justice, ensure domestic tranquility, provide for the common defense, promote the general welfare, and secure the blessings of liberty to ourselves and our posterity.
We the people are all our heroes, and Perry Automotive knows that. Now until the end of the year, we're extending our local heroes discount to the people. because you are all heroes.
Welcome back to Your Wealth Health. I'm Bill Davis, filling in for Eric Brenner. I'm here with my partner, Matt Aurenz, private wealth advisor with Hilltop Wealth Solutions. Have an exciting, some exciting news. Ed Slott is a world-renowned IRA expert that we belong to his elite advisor group. The elite advisor group are 400 of tens of thousands of advisors that are out there that are go through the training with Ed to get that elite advisor status. Ed's going to be here on June 13th live on the show, and we're really excited to offer that to our viewers here on coming up on June 13th. So Matt, we wanted to jump back into the tax control triangle and talk a little bit about the non-qualified assets and what kind of fits in that bucket.
Sure. So Bill, again, those are post-tax contributions, money that's already been taxed when it goes in, and you pay tax along the way. And so if you have one of those accounts, you traditionally every year you get your 1099. It has dividends, interest, capital gains, taxation. So you could have individual stocks or bonds. You could have real estate. You can have a CD, something of that nature. Your bank accounts, and those accounts. What we traditionally see is just making sure when we talk about estate planning with those, Bill, it's always make sure you have proper beneficiary designations on those accounts, and a lot of the tax on those at death can be washed away with something that's called a step-up in basis. So whoever inherits that, as long as there's a relation there, it has to fall in line with what the IRS says. But that unrealized capital gains a lot of times can be washed away for the beneficiary, so they're not paying that tax implication upon receiving that.
Yeah, you bring up a good point, Matt, and that has to do with transfer on death beneficiary designations on non-qualified investment accounts. That's commonly missed and forces the assets to settle through a probate. And so you can also do the same thing with banking and credit union relationships by putting a POD or a payable on death. Now Indiana allows you to have a TOD deed on your home, so that may be something. So all of those would be non-qualified type investments that you can just make sure you don't have any probate by doing PODs, TODs, and TOD deeds.
Right, and a lot of that, Bill, seems overwhelming. But again, it's one of those things that our belief is once you sit down with somebody and write out a list of what you own, what has beneficiaries and what doesn't, it's an uncomfortable conversation, but once you get it done, you know that you've made a right decision and you don't have to worry about it anymore.
And I like to accumulate money in this non-qualified bucket, whether it's in the bank or your money market or CDs, not CDs, but in money market or bank and savings accounts, because that offers flexibility when we talk about moving money to other buckets. So if you've accumulated $12,000 or $14,000 in your non-qualified investment bucket, you can move that to your Roth when you go to do your taxes prior to tax filing deadline, which of course this year has been extended to July 15th. So there might even be some opportunities for people to do deductible traditional IRAs or get their Roth funded if they haven't completed their taxes yet for the year.
Right.
But let's move on into some tax planning type discussions, Matt. And I think first off, determining what your own tax bracket is.
Right. That's if we were to take a look at kind of the tax strategy, our belief is there's three things right now that we're looking at: is know your tax strategy, know your tax bucket, know your income sources, and then the third would be know what your income needs are. And knowing your tax bracket's a big thing, Bill. I think a lot of times people will say, well, what tax bracket are you in? Or I'm in this tax bracket. And that kind of works. There's an effective rate, there's a marginal rate, there's the rate that the Fed puts out or the IRS puts out. And you got to know which one you're falling into. I mean, all of those work a little bit different, and it's because it's a stair-step type of thing. But knowing what bracket you're in will allow you opportunities like Roth conversion, contributions. Do I make deductible contributions to a 401k? It allows you to say, I'm going to be being pushed into a new tax bracket, or reducing my income enough to drop down into another tax bracket.
Right, and that's why, Matt, it's the first step, is determining what effective tax bracket you're in. Once we know the effective tax bracket you're in, we know the upper limit of that existing tax bracket, that we can now determine repositioning of assets. So Roth conversion, that's a very important calculation if you're going to be doing a Roth conversion, is to try to limit your currently, if you're in the 22% tax bracket, you probably have an effective rate of, call it 12 or 13%. So just making sure that you're going to take advantage of that effective bracket all the way up to the 22% limit, which in the Secure Act, the tax brackets were changed for the first time, and so we can now take more income at the same current tax bracket that we're in. But you also then, in your second point that you brought up, Matt, was know your income sources. Right. Talk a little bit about taxability of Social Security, for example.
Sure. You know, Social Security is one of those income streams that everybody, or most people, will think oftentimes when I retire, hey, I get this source of income, Social Security comes to me like a pension. I already pay tax on it. You know, Social Security was taken out of my paycheck for 30, 40 years. I've paid the tax implications, and all of a sudden at the end of the year they get their 1099 W-2 on Social Security, and oh, I have to pay income tax. And it's really a shocker for a lot of people. And the way Social Security is taxed in retirement income is it's either not taxed. There are people who fall into a non-taxable Social Security distribution, or it is taxed. And if it is taxed, 15 or 85% of your Social Security check will be taxable. And you have to know what your sources of income are and what your provisional income looks like to determine, will my Social Security be taxed or not? And if it is taxed, will it be taxed at that 15 or 85%?
Yeah.
You know, and then you add other sources of income, Bill, pension income, IRA distributions, Roth distributions, 1099s on my interest and dividends and income, capital gains. You know, you're getting all these sources of income, and some are taxable, some are not. Some are taxed as ordinary income, some are taxed as capital gains. It becomes a complicated mess.
And that's why we try to make it simple by using the tax control triangle to help people understand how buckets of money are taxed. And so it's not uncommon that we have clients that get surprised when they have a spike in income and a spike in their taxes, because all of a sudden those income sources put them over the 50 or the 85% limit to have your Social Security be taxed. So about the first time that you get 50% of a Social Security for a couple being taxed, that can be a significant change and lead to what we know is higher tax brackets. So Matt, this has been a great conversation. We're looking forward to continuing this conversation in next week's show, where we're going to actually have some specifics on, a normal couple that we see and deal with, and start to apply some of the strategies that are potentially available to our audience. So that's going to be exciting. And then the week after that, having Ed Slott is a tremendous opportunity. If you haven't seen Ed on public television, that's where we most commonly see him throughout the country. You'll be excited to see Ed. He's just a great speaker and quite a wealth of knowledge. Please join us again next week on Your Wealth Health, and we'll jump back into some of those Secure Act strategies. From Bill Davis, Matt Aurenz, have a great week, and we'll see you next week.